Is the stability of the U.S. banking sector more of a mirage than a reality? This question is not as far-fetched as it may seem, particularly when we examine the current state of regional banks across the country. This story begins with a bold prediction from Barry Starlet, CEO of the $15 billion real estate juggernaut Starwood Group. He foresees a future riddled with bank failures, at least one per week, all rooted in vulnerabilities in real estate loans. This alarming forecast is not a solitary voice in the wilderness. It echoes the concerns of other financial leaders and aligns with recent events, such as this year's first casualty, the Republic First Bank. But what if this is not just a series of unfortunate events? What if it's a scheduled demolition? There's a growing belief that the hardships of regional banks might be part of a larger orchestrated contraction. This theory points to a systematic dismantling that could wipe out many regional banks by next year. The culprits? A combination of pressures on commercial real estate, high inflation, and shifts in consumer banking behaviors. Regional banks are in the hot seat because of their significant holdings in commercial real estate debt. Historically, these banks have been the go-to lenders for the real estate industry, an industry now buckling under the pressure of higher interest rates, increasing vacancies, and relentless inflation. The situation worsens as customers pull their deposits in search of higher returns from other financial instruments, putting even more strain on these banks. The Federal Reserve's aggressive interest rate hikes, a strategy to curb inflation, is adding fuel to the fire. Rising borrowing costs are pushing property values down, creating a precarious situation where banks may start seeing defaults on loans that once seemed secure. This domino effect could impact not just the banks, but the broader economy. The grim prediction of bank failures could significantly reshape the banking landscape in America. As smaller regional banks stumble, the likelihood of consolidations increases, potentially leading to a market ruled by a few large players. Such consolidation could have far-reaching effects on credit availability and economic diversity. In these turbulent times, consumers are advised to ensure their financial health, particularly their credit scores. High credit scores could become even more critical as credit tightens and banks look to minimize risk. Keeping a good credit history could be key to accessing loans and other financial products in a more constrained market. In conclusion, the potential collapse of numerous regional banks in the U.S. could not only reshape the banking sector, but also the real estate market and the wider economy. The implications could be profound, affecting everything from the stability of the housing market to the financial health of everyday Americans. As we continue to monitor this situation, the importance of financial prudence and preparedness cannot be overstated. Remember to like and subscribe for more insightful content.